This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, eventually we do get to section 7 and get now to discuss lifetime exemptions. Now, as you can see here in the note on what is page 145 here in terms of chapter 24, we have up until now, when dealing with our illustrations, spoken about computing for IHT the transfer of value. And what that transfer of value represented, as we saw back in illustration 1, was the difference between what the transferor had before the transfer and what he had after the transfer. And that is best illustrated when dealing with lifetime transfers. On death, we know that, the major occasion of charge, of course, but on death, what you had before was everything you owed, and what you had after death is nothing at all. So it's a very simple comparison. It will just be the market value of what you owned at the date of death. But on lifetime transfers, you may be giving away assets such as shares in unquoted companies, where there's a different price per share that is applied to different levels of shareholding. So it is not the market value of what is being gifted that counts. It is the loss to the estate of the donor that counts. That difference between what the donor had before and after. But from illustrations 2 through to the most recent 11, what we've been doing in terms of IHT computations is to tax what we called a chargeable transfer figure. So somehow we have to work from the transfer of value, the simple before and after, the loss to the estate of the donor computation, down to the figure that will then enter into any of the IHT computations. Principally, of course, as far as lifetime is concerned, we're talking about the CLTs, the lifetime transfers chargeable when made, and then the transfers, lifetime transfers that become chargeable on death, which is PETs for the one and only time, and potentially CLTs for an additional tax charge, but only if they were made within the 7 years of the date of death. So what we've got to do is to work from a transfer of value down to the chargeable transfer figure, and what that may involve is the deduction of certain exemptions. Now, those exemptions to be deducted, they're not huge, there's not a huge amount here to remember, are either or both of two exemptions. There is an annual exemption. We're used to the idea of annual exemptions, allowable deductions in relation to tax. We firstly came across a personal allowance in income tax. In CGT, the tax most close to IHT, the other capital tax as it is known, we've got an AEA, an annual exempt amount. So it is here that in relation to our lifetime transfers, we have, and it is only on lifetime transfers that we have these exemptions applicable, we have the ability to deduct an annual exemption each year. And then there is a very specific one, a marriage exemption. Here, a transfer that is made by the donor on the occasion of the donee's marriage. And that, depending on the relationship of donor to donee, it could be parent to child, grandparent to grandchild there, or any other relationship. Then there are 3 sets of level of marriage exemption that we'll need to become familiar with. We'll talk about those in a moment's time. But in addition to those exemptions that are deductions from a transfer of value, to bring you to still what will be a chargeable transfer figure, to then include in one or other or both of those computations, lifetime transfers chargeable when made, lifetime transfers chargeable on death, there are some exemptions, and they're listed here, that are just full exemptions. Here there is no deduction from the transfer of value. These exemptions apply in full if they are available. So let's get these out of the way first, because these are probably the less likely ones to be seen. The annual and the marriage are the most likely. First of all, there's a small gifts exemption. Now, we measure small by gifts up to £250 per donee per tax year. Per donee. So you can give any number of different people up to £250 per tax year. So this is an aggregate total for the tax year. So if I make a single solitary gift in the tax year of, say, £200 to a nephew, niece, friend, relative, whatever, there, then that single solitary gift of £200, that is not more than £250 per donee per the tax year, and that therefore is exempt. It means it will not come into any IHT computations. Whether you do or whether you don't die within the next 7 years, it is exempt, end of story. It is, however, though, per tax year, as we've underlined there. So be careful. Tax year, as well we know, runs from the 6th of April through to the following 5th of April in any years. And what you've got to watch out for is that possibly as you read through, as it will be, and you'll see with the example below in a moment's time, the chronology of lifetime gifting, you might see that our taxpayer, the donor concerned, made a gift to his or her nephew of £200 on the occasion of the birthday of the individual. And that was in, say, August of the, let's say, 2016, August 2016. So 200, great. That, if it stands alone in the tax year, would be a small gift and would be exempt. But just check very carefully. If that's August 16, check through to the 5th of April 17, the end of the tax year. Because if at Christmas time, in December there of 2016, in our same tax year, 16-17, another gift of, say, £100 were to be made, well, 200 plus 100, that's 300. It's no longer a small gift. So we do not look at each individual gift by comparison to 250. It is per donee, per tax year in total. Gifts for family maintenance, probably the least likely one to be seen. But yeah, any gifts made to maintain family members are fully exempt. So again, you might have an elderly relative that you are seeking to support here and you make gifts to them. Any such gifts made to maintain such a family member will be fully exempted. Again, probably the least likely we're ever going to see an exam question. What may be involved? Normal expenditure out of income, though this one is a little bit tricky to, of course, determine in exact form because there's no specific level. But let's look at what we need to know. It's normal expenditure. So the donor must show a regular pattern of giving. So it's not a one-off gift that we're talking in terms of. Now that could be like a moment ago. We make a gift on an individual's birthday or at Christmas time or any other festival that you may be celebrating there. And if you do that on a regular basis, that gives it the chance of being exempt irrespective of the amount, no financial limit placed on this. But the provision is that the individual must have enough income left to retain their normal standard of living. So the transfer that occurs, the gifts that occur each year on this regular basis, it's normal, must be out of income. The idea is a simple one. If you have sufficient income to maintain your standard of living and make generous gifts to your friends, to your relatives there, then what you choose to do with your money is entirely up to you. You making such a gift, you are not reducing the value of your estate. You are simply choosing not to increase the value of your estate, and that therefore does not represent a chargeable transfer, and no tax will be chargeable. So, as this small gifts one is quantifiable, again, as you're likely to see inheritance tax in a section B question for 10 marks with 5 individual OT questions, then probably the small gifts exemption is the most likely of these to be tested. But any of those, if applicable, are fully exempt. The ones that we are almost certain to see in dealing with any lifetime transfers made by the taxpayer are these two here. Firstly, the annual exemption. Now then, as we've said, we're used to the idea of each year having a tax-free limit in terms of taxation, whether it's your personal allowance in income tax, whether it's your AEA, your annual exempt amount in CGT. Now here the amounts are not that big, and we've had this level for years and years and years, so it is applicable throughout. Whichever tax years you are dealing with the lifetime transfer for, it's going to be £3,000 as your annual exemption. So the first £3,000 of gift each tax year is exempt, the first 3,000. So it is applied, therefore, the exemption is allocated to gifts on a strict chronological basis within the tax year. If you have a gift in June 16, and that is the first one since the 5th of April 16, then that will be the first to enjoy any such annual exemption of that tax year. If it's June 16, we're in the 16-17 tax year. So if that was £3,000 or more, and it's followed by another transfer in August of 2016, then there'd be no annual exemption left to go against it. So it is applied strictly on a chronological basis. And that is true whether the transfer that you are dealing with is a PET or a CLT. Now, we know that CLTs are immediately chargeable when made. We don't wait around to see whether the taxpayer dies within the next 7 years. It's immediately chargeable. Whereas with PETs, at the time you make them, there is no immediate IHT liability. And what was potentially exempt when made would become exempt if you live for more than 7 years. Now, whether you do or whether you don't live for those 7 years, if you make a PET first in the tax year, then it will enjoy the use of any annual exemption. So that would therefore seem to suggest that if you were planning within a tax year to make both PETs and CLTs, then as PETs you hope, those PETs will not become chargeable to tax because you've got every desire and wish and plan to last for at least 7 years, then it would be sensible to ensure that it is the CLT that uses up the available annual exemption, because that is chargeable there and then. So you'd plan to make CLTs earlier in the tax year prior to then any PETs being made. If, of course, as it will be in a question, you are told in the tax year, there firstly is the PET followed by the CLT, then it's the PET that will benefit from that annual exemption, or, as we're about to discover, annual exemptions. Now, normally we've had the view, like with AEA, like with personal allowance, a very basic rule of thumb, that is, use it or lose it. If you don't have any income in a tax year, or if you don't have £11,500 worth of income in the tax year, any unused personal allowance would be wasted. As too with the AEA, if you don't have any gains, or you have gains less than the AEA of the year, you don't carry forward any unused AEA. But here, to a limited extent, if we do not make a transfer, or if transfers are less than £3,000 for a tax year, then, back to our note now, any unused annual exemption is carried forward, but a maximum of 1 tax year. And it is then for use after that year's own annual exemption. So if, for example, I make a transfer of value, a PET, shall we call it, this tax year, I give £5,000 to my son. I'm sure he'd be very pleased. I give £5,000 to my son, and that is the first transfer I have ever made for IHT purposes. In which case, what do? I clearly, if it's the first one that I've ever made, I've made no other transfers in this tax year and no transfers in the previous tax year. So what does that mean? This tax year I have available 2 annual exemptions, but the unused AEA that is brought forward is for use after that year's own annual exemption. So against the £5,000 transfer of value, I would use firstly the current year's annual exemption of £3,000, followed by a further £2,000 of the previous year's unused annual exemption. That would still leave £1,000 of the previous year's annual exemption at this moment unused. And if this were the only transfer I made in this tax year, then I can't carry forward that £1,000 for more than a year, so it would lapse at the end of this year. So always remember, where you have available an unused annual exemption brought forward from the previous tax year, you only use it after this year's own annual exemption has firstly been fully used. Don't worry, we'll be testing these issues in just a moment's time. And then the marriage exemption. Now this one is very specific, quite obviously. An annual exemption will go against any transfer of value that would otherwise be chargeable, and whether it's a PET, whether it's a CLT, and will be applied on a strictly chronological basis within the tax year. Clearly this one is very specific. It is a gift, of course, in consideration of marriage, and whenever we talk about marriage, it is equally applicable to civil partnerships. A gift in consideration of marriage or civil partnership is exempt up to certain limits. Now again, it depends on the relationship of the donor to the donee. Remember, IHT is a donor-based tax. So for each of the parents of the bride or groom, a parent of the bride or groom can give to their child £5,000. Now they can give whatever they like. I'm sure the child would be very happy to take more, but the first £5,000 of such a transfer of value is covered by the marriage exemption. For remoter ancestors, for example, grandparents giving to their grandchildren, and indeed, we'll talk about this one in a moment, for parties to the marriage themselves, the exemption is £2,500. So grandparent give to grandchild up to £2,500 exempt. Again, with these exemptions, if you go above the level of the exemption, you simply deduct the level of that exemption. You deduct £5,000 if you are the parent of either the bride or the groom. You deduct £2,500 from whatever is the transfer of value if you are the grandparent of either the bride or the groom. Odd, though, about parties to the marriage, because what you might be thinking, hang on a minute, parties to the marriage? Well, they're spouses or civil partners, and any transfers, there's no limit, any and all transfers between spouses or civil partners are exempt. Yeah, but that, of course, is after they have entered into that marriage or civil partnership. We're talking about transfers happening here prior to that marriage, on the occasion of that marriage. So it means there, if there's any boys listening out, equally any girls, you might want to take a note of this, that the husband-to-be can therefore afford, without any fear of IHT whatsoever, to spend up to £2,500. Girls, I probably think you'd say at least £2,500 on the old engagement ring there. And he won't have to worry about any IHT. I'm sure that's a winning argument there to get him to spend that amount on the ring. After they've married, well, even better, ladies, they can pour on you, those husbands of yours can pour on you whatever benefits, whatever gifts they wish. But equally, from the male perspective, might I say, it works the other way round as well. Right, we've got here two specific exemptions that apply against lifetime transfers. What you may get, therefore, is both exemptions applying in relation to a marriage. So these exemptions, firstly marriage, if available, and then annual exemptions, are deducted from the transfer of value to compute the amount of chargeable transfer. This is the point that we keep making. The basic transfer of value must exist in the first place for IHT to be at all involved. But then we have to, where appropriate, when dealing with a PET or CLT, deduct from that the relevant exemptions. Marriage, specific, and if applicable, first to be applied, followed then by any annual exemption. Clearly, if it's not on the occasion of marriage, there is only the annual exemption. Those are deductions from the transfer of value to give you the chargeable transfer figure. Any of these down here, then there is no deduction from the transfer of value. It is simply that the transfer of value is exempt, so there is no chargeable transfer whatsoever. Right, what we've now got to do, therefore, is to see how to apply this. And as luck would have it, we have a little illustration here, illustration 13, hopefully not unlucky for some there. Now then, All this one says is to compute the chargeable transfer figure for each of the following lifetime transfers. Now again, in terms of any Section B IHT question, we may get a building exercise where we need to compute chargeable transfer figures for 1, 2, maybe 3 different transfers. We then have to move on and then establish maybe for a CLT any lifetime tax that may be payable in relation to the CLT. In relation then to the later death of the taxpayer, what additional tax on the CLT and what tax then becomes payable for the one and only time on those pets made within the 7 years of the date of death. So individual 2-mark objective testing questions built around the overall scenario, but they take you through it, this requirement, etc, etc, etc. Right, as we read a question, however, and we are told about transfers of value, the first thing we need to identify about the transfer of value is what label to apply to ascribe to that transfer. Now we should know that in IHT terminology there are any of 3 different types of transfer. They are a transfer to a spouse or civil partner. It is exempt. Therefore, all you've got to do is note that it is exempt. On an OT question, you don't even have to do that unless it specifically asks for you to identify any exempt transfers or any chargeable transfers, and therefore you exclude the exempt transfer. So transfer to spouse or partner, exempt. A transfer into a trust, that is a CLT. What does that mean? It enters into 2 computations. Firstly, at the time, for that tax year, lifetime transfers chargeable when made. And if sadly the donor dies within 7 years, the lifetime transfer is chargeable on death. And then basically any other gifts made in lifetime are potentially exempt transfers. They no immediate IHT liability and will only be chargeable. Again, I don't know how many times we've said this now, but again, hopefully we remembered it. Only chargeable if you die within 7 years of having made them. What we've then got to do is, if the transfer of value is one that would be chargeable, it's either a PET or a CLT, it's other than an exempt transfer, then we need to look for the various exemptions that might apply, the marriage and the annual. If, of course, we've got something like a small gift, then that would be exempt full stop and wouldn't create also any chargeability. So let's go through each of these and see how we would identify relevant information about each to be able to compute the chargeable transfer figure for each of these lifetime transfers. Right, first of all, look at the date. So June 16. Now we know that we're going to be applying annual exemptions where applicable. That's to anything other than is exempt, and we do that by reference to a tax year. So here it would appear the very first transfer to have been made ever is the June 16 date. And what is it? A gift to her daughter of £2,000. Right, a gift to her daughter. So it's not an exempt transfer, it's not a CLT, this is a PET. And it's the first one in the 16-17 tax year. Therefore, irrespective of the fact that there were no transfers in the previous tax year, so there'd be an unused an annual exemption, which annual exemption do you use first? The current year. So we would know we'd have available the annual exemption for the tax year 16-17, 2016-17. Now that would use up 2,000, of course. It's only a £2,000 gift. Had it been 20,000, we would have used all of the AEA of 16-17. Then we would have used all of the AE, did I say AEA? All of the annual exemption of 16-17, followed by then also the preceding tax year 15-16. But it's only 2,000. So we've used up 2 out of the 3,000 available. On to August 16, so we're still in the same tax year. It's a wedding present to her son. So again, a gift to her son, that is a PET. It's a wedding present to her son. Therefore, there is a marriage exemption that is available. ME, yes, it's all about me. A marriage exemption there to your son or daughter, £5,000, £5,000. But this transfer is £5,500. So what that therefore means is, do we now have any amount of annual exemption available? So we're still in the 16-17 year. We've covered of that 5,500, 5,000 by the specific marriage exemption. So yes, we'll now use up another 500 of the remaining 1,000 left after the 2,000 had been applied on the June 16 transfer. So again, we've got the use of the annual exemption of 16-17. On we go. September 16, still in the 16-17 tax year. But it doesn't matter because it's a gift to her husband. Therefore, that is an exempt transfer. No calculations to do, not chargeable now, not chargeable ever. It is exempt. Nor does it use up, of course, any exemptions, therefore. On to the next one. July 17. We've now moved into the next tax year, the 17-18 tax year. So it means that we can use up the annual exemption, as we'll see in a moment's time, for 17-18, and then look back to see if there's any unused annual exemption from 16-17. The previously unused annual exemption of the 15-16 tax year will, of course, have lapsed by the end of 16-17. You only get to carry forward for 1 year. So let's see whether we can sort this out. A gift to her nephew. A gift to the nephew. It's a pet. As a wedding gift. Right, a wedding gift, therefore. Now, a wedding gift, gift to nephew, that's not child, that's not grandchild, that's not party to the marriage, and on that basis, therefore, it is a marriage exemption of just £1,000. It's not 5, it's not 2.5, 1,000. This is anybody else. So marriage exemption 1,000, but that's 8,000. So after using up the specific marriage exemption, like we did earlier on the wedding present to her son, we then move to look at any annual exemption. Right, we're now in the 17-18 tax year. It's the first gift in the 17-18 tax year, so we'll use the annual exemption for 17-18. That is 3,000. So we use up all of the current year's annual exemption. We'll then look to see, do we have any unused annual exemption coming forward from the previous tax year? And we do. The 16-17 annual exemption used in the year was 2,000, and then against what was 500 left after the marriage exemption of 5,000, we used up £500 worth of the annual exemption of 16-17. So we'd used up 2,000 there, 500 there, so 2,500 was used. So we've still got AE 16-17, we've got £500, not 500,000, but £500 there. On we go. December 17, 25th of December, Christmas time. A gift of £200 each to 2 friends as a Christmas gift. Yeah, £200 each to 2 friends. 200. That does not exceed £250. Therefore, it is a small gift. But be careful, just look through to the end of the tax year to see whether more than £50 additional gift might have been made to the same friends. Because if there were, then we look at it per annum per donee by reference to the small gift exemption of £250 there. Now, there are no further gifts. It was just £200 per donee per the tax year. So that, therefore, gets the benefit of the small gift exemption. And on we go to the final one here, 20th of March 18, a gift to a trust. Nah, what label do we apply to that one? That one, of course, is a CLT of a valuable painting worth £100,000. Now then, March 18, we're still in the 17-18 tax year, and we've already used up the 17-18 annual exemption, so there are no annual exemptions to go against this CLT. Not particularly good timing here by the taxpayer concerned. It would have been wiser to make the CLT first within a tax year, or here at least to delay until the next tax year. Wait until the 6th of April 18 and then benefit from the 18-19 annual exemption. But that's not what happened. Clearly they didn't ask us for advice, and on that basis it's just the full £100,000 that will be chargeable. Now there's a summary here of what we've said about the analysis of those transfers. The gift on the 19th of September 16 is exempt as a transfer between spouses, and the gifts on the 25th of December 17 were exempt as they were covered by the small gifts exemption. June 16, August 16, July 17, they were pets. And of course the final 25th of March 18 gift into trust, that was a CLT. Again, showing it properly, if it were a full written exercise that you were doing, it is unlikely that it's going to happen in terms of a Section C question. It's not impossible. Anything can happen. But it's more likely you'll be answering objective testing questions. So these workings that you still need, you're going to be doing in a quick and a rough basis, therefore, on your working paper, rather than presenting it to the examiner. But we list out all of those transfers that are either chargeable when made, CLTs, or are pets that therefore would become chargeable on the death of the taxpayer within 7 years. We list out the transfers of value, and as we have just done, we apply the exemptions. On a chronological basis, there's the annual exemption of 16-17, fully taking out the transfer of value, no chargeable transfer. We're working down to a figure of chargeable transfer. We then had the gift to the son on the wedding there, 5.5. Marriage exemption, first to apply, was still in the 16-17 tax year. We used another 500 of that annual exemption. Again, nil chargeable transfer. On to the pet in July of 17, transfer of value 8,000. That again was to a nephew, but on the occasion of a marriage. So we got a marriage exemption here of £1,000. It's the first in the 17-18 tax year, so we get the full 3,000 for the current year. We've only used 2,000 plus 500 of the 16-17 annual exemption, so there's 500 remaining. By now we're into 17-18. Sadly, none of the 15-16 unused annual exemption is available to us. We only got to carry it forward for 1 year. And as we've seen, for use after that year's own annual exemption. Hence why here, in 16-17, we firstly applied the 16-17 annual exemption. Again, have a little read through the note there for 1 moment, please, and make sure that we're happy with how we work from a transfer of value down to your chargeable transfer figure. Well, in our next session together, we'll be moving on to what you can see here as session 8, our approach to an exam question. So we'll be attacking an exam standard question in terms of the work that would need to be done, dealing with lifetime transfers that are both chargeable when made and chargeable on death, and also sorting out any IHT that becomes chargeable on the estate at death. And what I want you to have checked out and revised prior to us talking about this and doing this example one here next time is this approach, so you know the things that we are looking to do. As we have just done, you go through the list of lifetime transfers made and compute the chargeable transfer for each lifetime gift. Remember, any transfers that are just exempt do not come onto that computation. If required to state what is exempt, we can do so, or pick it from a list indeed, but we are interested now in the chargeable transfer for each lifetime gift. That will be both pets and CLTs. If we do have a CLT, if any CLTs have been made, the computation that will be headed lifetime transfers chargeable when made. Now I say headed, this isn't going to go into your answer. They're going to ask you to calculate the tax that was payable in lifetime, but you're going to need that computation to allow you to get that tax. That must be prepared as per illustration 11. So before next time, you go back and you look at how it was that we computed the tax that was payable in lifetime. Now, compute that tax payable, you had to ascertain who paid the tax. Was it the donor or was it the donees? So as to determine the tax rate to apply, but you only apply either the net rate, 25%, or the gross rate, 20%, where you go above the nil rate band, the available nil rate band in the year in which the CLT was made. Remember, it's a cumulative donor-based tax. When dealing with CLTs, you work over a cumulative 7-year period as regards the availability of any amount of nil rate band. Once we dealt with those, then any lifetime transfers, by which we mean CLTs or pets, made within the 7 years of death are now included in the computation that, for our working purposes, we label lifetime transfers chargeable on death. Illustrations 10 and 12. Go back and check those out. We now bring in, on a chronological basis, going back from the date of death 7 years, and then start to work forward from the earliest transfer onwards, whether PET or CLT work from that. Once we have used up any available nil rate band, then tax becomes payable at 40% on death. But that tax charge may then be reduced by any taper relief that may be available. And not only by taper relief, but in the case of a CLT, if there were, doesn't have to have been, but if there were to have been lifetime tax that was payable, we went above the nil rate band that was available at the time of the transfer itself, then if there was lifetime tax, then that is credited back against the tax charge arising on death to compute an additional tax due on death, if any. And only after all of those things have been done do we then move to the chargeable estate. And in computing the tax thereon, basically the chargeable estate, of course, is a listing exercise, listing out all the assets held at the date of death, applying any relevant valuation rules. Go back and remind yourself of those relevant valuation rules there. There aren't many of them. But what do we do with a residence? Do we deduct a mortgage from the value of that residence there? What do we do with life policies? How do we deal with those? What value comes into the death estate? And also, of course, then we need to know, after having dealt with the transfers made within the 7 years before the date of death, do we have any available nil rate band? Plus, if there is a main residence in that death estate and it is being gifted to a direct descendant of the taxpayer, of the deceased, then we're going to be using the residence nil rate band as well. So we need to know what is available. Now again, in short exam questions, not all of the above steps may be necessary, or indeed they may be divided, as they're likely to be, into individual objective testing questions for 2 marks each. Hence the steps should be applied as applicable to the question set. May also be required to state by whom and by when IHT should be paid, whether that is in relation to lifetime transfers, chargeable when made, CLTs, or whether it is in relation to tax becoming due on the date of death. Go back and remind yourself of those. Before then, next time, we will come and we'll have a go at the first of the 2 examples that remain within this particular chapter for us to work, and these are exam standard material that we're talking in terms of. Well, I look forward to working through that example 1 with you next time. Make sure you're prepared for it.